back to JPX and market weekly updates. Crude prices fallen by around 6% last week, and were back at near levels from August 22nd, when Saudi first flagged the kingdom would consider production cuts. The hawkish rhetoric from the U.S. Federal Reserve had been a major driver. The potential return of Iranian oil to the markets also weighed on sentiment, as French President said Thursday that he hoped a deal to restore nuclear limits on Iran would be agreed in the coming days. Adding to the downturn, a fresh wave of Chinese lockdowns were announced, placing millions of citizens under renewed restrictions following a fresh outbreaks of COVID-19. Crude oil futures in Asian trading hours Friday were climbing higher as Russian supply concerns and the upcoming OPEC meeting helped stabilize prices after a week of losses. Dubai cash for November delivery was set at $94.8 per barrel last Friday, up 80 cents from the previous Asia close, while JPX Dubai futures were trading at $87.5 for the November contract. The first line and third line JPX Dubai future contract was trading at $3.5 a barrel on Friday. The prompt Dubai structure strengthened as the first line and third line used by national oil companies in official selling price calculations was patched at around $5.7 a barrel. Saudi Arabia is expected to slash the price of its flagship grade to Asia for October amid lackluster fuel demand and increased competition from crude from other regions, a Reuters survey of refiners showed. Crude markets have also been dragged lower by weakness in products. Gasoline cracks in Asia slumped to negative levels last week for the first time since 2020, which has been exacerbated by renewed COVID restrictions in China. Diesel cracks tanked lower on gas prices. Natural gas markets continued sharp reversal on Wednesday and Thursday, despite Gazprom starting a 3-day maintenance shutdown of the Nord Stream pipeline, with both Asia and Europe dropping by 25 to 30% since last week's record highs. Because light and sweet crude oils are cheaper and easier to process into low sulfur content, high-quality gasoline and diesel, explaining their growing attractiveness for refiners when these product cracks are high. As light distillate cracks slumped and refining margins continue to be eaten away, meanwhile, underlying volumes in the North Sea dated Brent benchmark are set to rebound in October as extended North Sea maintenance and upweighting work is completed for the summer season. The Brent and Dubai cash spread crunched to two-year low on Thursday, while IC Brent and JPX Dubai spread was trading at $5.5 a barrel. On the supply side, the group of 7 countries announced an agreement to cap on Russia's crude oil prices starting December the 5th and for oil products 2 months later. The provision of such services would only be allowed if the oil and petroleum products are purchased at or below a price determined by the broad coalition of countries implementing the price cap. The price level remains under discussion, and the policy will be enforced through insurance finance and shipping restrictions. The G7 countries' agreement to finalize and impose a price cap on Russia's export is expected to diminish the current discount against global benchmarks and widen the pool of buyers of its oil. However, oil prices rallied after comments from Deputy Prime Minister that Russia would stop supplying crude and products to countries that impose a price ceiling on its oil, speaking ahead of Friday's G7 meeting to discuss the price cap proposals. The comments raised the prospect of further disruptions to oil energy supplies over the winter. The effectiveness of the price cap may also hinge on the position of large third parties such as China and India that have bought up cheap Russian oil since it was shunned by Europe, the United States, and others shortly after the war in February. Russia's seaborne crude shipments to Asia have fallen by more than 500,000 barrels a day in the past 3 months, with flows to the region hitting their lowest level since late March. The G7 also called on OPEC to continue raising supply, encouraging oil-producing countries to increase their production to decrease volatility in energy markets. OPEC's output hit 29.6 million barrels per day in August, the highest level since April 2020, according to a Reuters survey. The OPEC Plus Joint Technical Committee initially said that it sees global supply exceeding demand by 900,000 barrels per day this year, but subsequently revised it down to the figure of 400,000 barrels per day on Wednesday. However, the recent slump in oil prices had largely ruled out any prospect of further output hikes when the group meets on Monday, with ministers presented with an opportunity to shore up markets by announcing a reduction in output. Okay, that's all for today, and welcome back next week.